Let's talk about money. We use it every single day. It basically runs our entire world, but it's probably one of the most misunderstood things we've ever invented. We tend to think of it as coins and paper and numbers on a screen, but the real architecture behind it, oh, it is so much more complex and, frankly, a lot more surprising than you'd think. So let me just start with a question to get your gears turning. What if I told you that the vast majority of money in circulation today wasn't printed by a government? Not by a mint, not by a central bank? Because, well, that's the truth. Most of it is created by commercial banks. You know, the ones on every street corner, pretty much out of thin air. It happens with a simple keystroke every single time they approve a loan. And once you really understand that one fact, it changes everything about how you see the economy. Okay, so let's dive into this. To get our heads around how that's even possible, we first have to back up a little and agree on what money actually is. What's its job? See, here's the thing. At its core, money isn't really a thing at all. It's a system. It's a social technology. It's basically just an idea that we all agree to believe in so that millions of us strangers can cooperate with each other. So it's not about what it's made of, it's about what it does for us. And economists have pretty much boiled it down to four main jobs. First, it's a medium of exchange, right? This solves the whole barter problem. You don't have to find a guy who wants to trade his chickens for your web design skills. Second, it's a unit of account, just a common yardstick so we know what things are worth. Third, it's a store of value, so you can save up your work today and spend it next year. And finally, and this one is crucial, it's a standard of deferred payment. That's the foundation for all credit and debt. You know, the history of money is fascinating. It's really this long, slow journey of abstraction. We've been moving away from physical, tangible stuff and moving towards pure, institutional trust. I mean, think about it. We started with commodity money, things that had their own value, like cattle or salt. Then, around 600 BC, the Lydians came up with standardized metal coins. Fast forward a long way, and we get representative money. Those were the paper notes that were basically just IOUs for gold sitting in a vault. But then, in 1971, everything changed. The US ditched the gold standard and the whole world entered the age of pure fiat money. Money that has value simply because a government says so. And this quote right here, it just nails it. Money is a creature of the law. This gets to the heart of an idea called chartalism. It basically argues that our money isn't valuable because it's backed by gold anymore. Nope. It's valuable because the government demands that you pay your taxes with it. The government's authority is the backing. So that brings us right up to today. Let's pull back the curtain on this modern money machine and really see who's pulling the levers. Okay, so this is the part that blows most people's minds. The common myth is that banks are like middlemen. You deposit your savings and the bank lends that same money to someone else. But that is not what happens. Not at all. When you get a mortgage for a house, the bank doesn't go check its vault for the cash. It just opens your account and types in the numbers. Boom, a new deposit is created. And at that exact moment, brand new money just entered the economy. And this table here lays it all out beautifully. You see, money creation isn't just one thing. It's a layered system. Way at the bottom, you have the central bank creating what's called base money. That's the physical cash and the digital reserves that banks hold. But look at that middle row. That's where the action is. Commercial banks create the huge majority of broad money, the money we all use every day, through that lending process we just talked about. And then you've got this whole other layer of shadow banks, things like money market funds that create even more liquidity. It is a really complex system. Okay, so let's zoom out. We've got all this digitally created money. How does it actually move around the globe? And here's another one of those little surprises. Those global payment systems, what people call the rails of the financial world, they don't actually move money from one place to another. They just move messages. They're basically super secure messaging systems that send instructions between banks, telling them to debit one account and credit another. The money itself never really goes anywhere. And as you can imagine, controlling these messaging systems, that's a huge source of geopolitical power. For decades, the big player in the game has been SWIFT, which is largely controlled by the West. And because access to SWIFT can and has been used as a political weapon, you're now seeing other countries racing to build their own alternatives. China has CIPS. Russia has SPFS. It's like the financial map of the world is being redrawn right before our eyes. Which brings us right up to the present day and the next great transformation of money. We're moving away from physical objects and even bank ledgers into a world where money is purely digital.
And if you want a sneak peek at how fast this is happening, you just have to look at Sweden. In 2010, almost 40% of people there used cash for a recent purchase. Fast forward to 2022, and that number has crashed to just 8%. It has become the global poster child for a cashless society.
But this incredibly rapid shift brought some unexpected problems to light. It's what people are calling the cashless paradox. Sure, digital payments are super convenient, but they leave out people like the elderly, and they are completely helpless if the power grid goes down. So now, in a kind of ironic twist, the Swedish government, the leader in going cashless, is actually telling its citizens to keep physical cash at home for emergencies. And as we plunge into this digital world, there are two very, very different paths emerging. On one side, you have decentralized cryptocurrencies like Bitcoin. They aren't owned or controlled by any single company or government. On the other side, you have central bank digital currencies, or CBDCs. These are the opposite. They're state-issued, state-controlled digital versions of a country's currency. And this isn't just some tech nerd difference. It's a huge philosophical one. One path is all about user control and censorship resistance. The other is about efficiency and direct government oversight.
But in the end, it all comes back to this one idea. It doesn't matter if it's a seashell, a gold coin, a piece of paper, or a line of code. The value of money has never been in the object itself. It has always been in this shared belief, the social contract that says we can exchange this token for real goods and services tomorrow. And so that leaves us with the biggest question of all. As that foundational social contract gets rewritten in digital code, who gets to write the new rules? Should it be central banks, private tech companies, or should it be a decentralized network of users? The answer to that question is going to define not just our economy, but our entire society for generations to come.